welcome to the Bags to Riches podcast. I'm your host, Zach Ginn. I'm on a mission right now to help everyone make as much money as possible in real estate investing. I'm with our guest here, David Toupin. David is a real estate investor, multifamily wizard, and owner of Obsidian Capital, a real estate investment firm with over $100 million in assets under management. I'm pumped to have you on today.
What's up, man? Thanks for having me.
All right, so let's get started. Let's get the cliche thing over with here. How did you get started in real estate?
Yeah, so I started in college, kind of probably similar to you. I started when I was 19, turning 20. And like a lot of people, I thought, I always wanted to do commercial, wanted to do larger properties, multifamily. And I thought that I had to start with single family. So, I'd read Rich Dad, Poor Dad, listened to Bigger Pockets. I heard people going from flipping to then buying apartments and whatnot. So I actually started early in my senior year in college by wholesaling. And so I did that for about 6 months, closed a couple deals, did all right. But like I said, I really wanted to go into commercial multifamily. So I pretty much cut that off completely and went straight into looking for multifamily deals to buy. And that led me to, underwriting deals and making offers. And I got my first property in a contract, which is a 12-unit apartment complex. So that was the start for me. I had zero money. I was a broke college kid like most people. I couldn't buy it on my own. So I learned and figured out how to syndicate, which is basically a way to raise capital from investors who are passive, and they put money in the deal. I get a piece of sweat equity, and I manage it, oversee it, go through the plan, renovate it, and then we sold it. And investors make money. I make my money. So that's kind of the model that I do, and have done that over and over again since.
All right, sweet. So obviously it seems like the hardest part, me looking out, I know a little bit about multifamily. I've talked to some people. It seems like the hardest part about that is finding the actual money. Is that something you would agree to?
At first, I think so. Mm-hmm. Now I would say the easiest part is finding the money, because there's a lot of money out there right now. But when I first started, it wasn't easy. I mean, I was 21 when I did my first big deal. It was 100 units, and I hadn't graduated college yet, and I had to raise $1.7 million, and that was very difficult. That was by far to date the hardest thing I had to do in this business. And now I could raise $1.7 million with 3 phone calls. But back then, I didn't have the relationships. I didn't have the track record. I didn't have the experience. So it was not easy. But once you perform and you get people to understand your model and your systems, and you have really great reporting and people trust you, it's a lot easier to raise capital.
Definitely. So how did you find your first $1.7 million then?
Man, I was knocking doors, cold calling, asking for referrals. I mean, I had some of the people on my first couple deals that had invested, reinvest, and then I was asking them, tell some of your friends. And so really our core type of investor is, doctors, dentists, attorneys, entrepreneurs, local real estate investors, other business owners. That's kind of our core of who invests in our deals. So I just did whatever I could to reach out to that group of people and try and find that type of person, and put the deal in front of them, and use just my knowledge and really the numbers and the facts around the deal to show them that it was worth investing in. Our business plan had to make sense.
Now, a lot of people make what you do multifamily wise, making the money like very complicated. I mean, what's the easiest way you think you can explain it to someone like a middle school level of like how exactly you make your money?
Yeah, so we make money in a couple different ways. First way is in fees. We earn acquisition fees. So when I say I buy a $10 million deal, we normally do anywhere from a 2 to 3% acquisition fee. So that, we close on a $10 million property, that could be $200,000 to $300,000 at closing. We charge construction management fees for overseeing renovations. That can be anywhere from 5 to 10% of the renovation budget. Let's say you're doing $1 million renovation, that could be $50,000 to $100,000. And then we earn asset management fees, which is really us overseeing, and that's a percentage, normally 1.5% to 2% of the gross revenue that the property produces, on top of the property management company who gets their own fee. We use third-party management. And so our 1.5% to 2% of the gross revenue is to manage the property manager and make sure that the property is going according to plan and that we're hitting all our numbers. In addition, we charge a fee when we close on it too, a disposition fee for handling the closing. And then we have our sweat equity in the deal, which is normally our split with investors is like an 80-20. So investors put up all the money for 80% ownership, and we carve out 20% ownership in the property. So when it sells, investors first get their money back. Any remaining profits get split 80-20. They get the 80, we get the 20. So I think that's the easiest way to explain it. We also invest in all our deals. So we put money into that pot of money, that pool of money that goes towards the 80%. So we get returns on our money just like they do. And so as a deal sponsor or general partner, as they call it, those are kind of several different ways that you can make money.
Okay. And how did you learn all about this? I mean, as a 20-year-old kid, college definitely doesn't teach you how to invest in multifamily deals. I mean, how did you get the knowledge to do this?
Man, I mean, dude, it's like living in the business and doing it day in, day out. You pick a lot of it up really quick. But in terms of resources, I have had several mentors that have been great. There are a lot of books nowadays. There are a lot of events and seminars you can go to nowadays to learn a lot of the stuff. And then, YouTube, online, forums and whatnot. There's a lot of resources that teach about syndication and how this whole process works, podcasts and whatnot. So I just absorbed all that and then started acting on it. And once I put a couple deals together, started small. I learned a ton by being hands-on.
Okay. And could you break down just like the average deal that you do? I mean, something you did last year, just like an average deal, and show how you made the money, how you found it, the marketing side, and the entire thing about it?
Yeah, so we could take a 136 unit deal that we bought in Fort Worth, Texas. So we bought 136 unit. Most of the units are 2 bedrooms. I think it's like 30% 1 bedrooms, 60% 2 bedrooms, 10% 3 bedrooms. So we bought it for $65,000 a unit, or $8.9 million. We put about $1.2 million into it. So that puts us up to 10.1, and then we had fees and closing costs. So our earned fees on the front end were about $350,000 altogether. We actually rolled all of that into the deal. So we invested all that into part of the capital stack. We had to raise $3.6 million to close on it. So we put about 10% of the equity up to purchase it and close. And then we bought it. So we were all in for 10.5. The goal on this property was to get the NOI up to a point where the property's worth about 13.5 million in the next couple of years. And then the plan is to sell, and then we'll, distribute those profits to investors. So it's cash flowing from day one. Our first year goal was to hit a 6% annual return on that 3.6 million. So we hit that right on the dot. Next year, or this upcoming year, our goal is to hit about a 7.5% return, and then kind of going up year after year from there to about 8 to 9% on average. So are there any other details around kind of that deal structure you want me to specifically touch on?
Yeah, the only thing that really confuses me to an extent is obviously Dallas-Fort Worth is quite a while away from Austin. So how are you managing the properties? Making sure everyone is giving you rent checks on time? If there's a plumbing leak, I mean, what's going on with that?
Sure. So it's funny, it seems very far away, but it's relatively close comparison. I mean, I own properties in Atlanta, in Michigan, all over. So It's about a 3-hour drive. And how we do that is we have a third-party management company that does all of the day-to-day operations. So they hire and oversee the on-site staff. And I guess to dive even a little bit deeper, that's why we buy larger properties, because once you get into 100 units and larger, the property can support full-time on-site staff. So the rule of thumb is kind of like every 100 units, you can have a full-time manager / leasing person and a full-time maintenance person, so you get 2 employees. So if you have 200 units, you're going to have a manager, a leasing agent, and 2 maintenance staff. So once we have this on-site staff, it's pretty easy to find, as long as you're in the right markets, it's pretty easy to find a good management company that will then do the accounting and oversee the leases and oversee unit turnover, oversee maintenance, make sure it's all getting done. And then we do what I was calling as asset management, and that's why we get paid an asset management fee. Every week we get financials from the management company. We review it. We see, what are our payables right now? What are we owed from tenants? What's our delinquency? How many evictions do we have? What's our occupancy rate? And we just oversee and kind of manage all this in the background and make sure that they're doing what they're supposed to be doing. If we see that maybe 1-bedrooms are 100% occupied and we're leasing them up crazy fast, we might give them, the management company, we might say, hey, why don't you raise the rents $50 on that, because it seems like they're filling up really well. Or conversely, if we see the 2-bedrooms are 85% occupied at a property, we might say, okay, drop the rent $50 because we want to get the occupancy up. So we're looking at all these financials on the back end and making decisions. And then we actually go up to the property. We tour most properties twice a month. Our asset management team does. And so they go up there and they will make sure that, there's no major deferred maintenance that needs to be taken care of, make sure the property's clean, make sure the staff is performing well, and go over a lot of that stuff. So we're essentially babysitting the management company. But that's how we can do it from far away, is we don't have to be on site to actually manage it.
Okay. And another question I'd love to ask is, these deals just it seems like a very great deal, but how did you find the seller? How did you talk to them? It just seems like that's a huge part about this whole transaction.
Yeah, honestly, the hardest part of this business nowadays is finding a good deal. Mm-hmm. Hot market, everything's overpriced. You probably see the same thing in wholesaling compared to a couple of years ago. The way we found this deal in particular was through a broker who we had a relationship with. We had bought properties from him before, and so he had this. It was a 3-property portfolio actually that came up, and the owner took offers on all 3 properties as a whole or individually, and we bid on all of them, but we ended up just winning the bid on this one, and 2 other buyers got the other 2 properties. So it just came through a relationship, and the broker put this deal in front of a couple people, and we ended up having a strong bid, and we really liked this area, location, and the business plan that we had put together for it. We saw a lot of opportunity, and it turned out to be a really solid buy. Like I said, we bought it for $65,000 a unit, and properties right now in this area are going for $80,000 to $90,000 a unit. So it's ended up to being a really, really good project.
Okay. And do you always go through brokers, or do you try to? I know the guys sometimes cold call owners of these complexes.
Yeah, we do it all, honestly. So I since I started wholesaling, I took a lot of the tactics that you use in wholesaling and apply them to multifamily. So do you guys send mailers?
Oh yeah, all the time.
Your business, like yellow letter? Okay. So I got this, I'll show you right now. I got this huge mailing machine in this office room in my house. And so we send 500 mailers a week out to multifamily owners, just like you guys do to single family homeowners. So we send a bunch of mailers out. I have a team of 10 people that cold call every week. They make 50 calls each. And then we get on a call, and I give a little bit of, pre-coaching to them, and we kind of go over their leads, and basically if they bring a deal, if they find an owner that's willing to sell, they bring a deal and we close on it, I'm going to bring them in on it and partner with them. So I'll bring them in on the ownership side of the deal. So we make about 500 calls a week, and we make about 500 mailers a week out to direct. That's kind of our direct marketing type of approach. So with that, and then you can find deals online as well. So I'd say those are the 4 ways: brokers, online listings, direct mail, and then cold calling.
Okay. Yeah. So I see people like you sometimes doing very well. I mean, what's your opinion on other guys like you that are competing? Just like, maybe like Cardone Capital, things like that. What's the difference between you and him?
Yeah, well, I mean, they're a little bit different. I mean, he makes himself seem, he's a big player. They've got about $1.5 billion under management. I know a lot of people that invest with them, and they don't really produce that great of returns. He's giving people 4, 5, 6% annual returns. I'm a lot more conservative. We really target more of like a 7.5, 8 to 9% annual return to our investors, and like a 15 to 20% internal rate of return or average annual return, including the sale. So a lot of other people are doing what we're doing. I think the biggest thing for someone getting started is, even though I didn't have any money when I started, I had a lot of time that I was putting into it, and I hustled. So what I did was I took on more work, more of the project. I put it on myself to raise more money, even though it was a lot more difficult. But because of that, I was able to get a lot bigger piece of the deal. I still had to bring on people to sign on the loans with me because I had I didn't have the net worth and liquidity to qualify for the loans that we get. Okay. So I brought on a partner, a loan sponsor, a loan guarantor, and gave him a piece of the deal for doing that. A lot of people that are getting into this business and just getting started will put these big groups of people together, like 5 or 6 people, to go and buy a 150 unit property where a couple people raise the money. All together they can qualify for the loan, and at the end of the day you're splitting the pot 5, 6, 7 different ways, and it's like, how much are you really making for all the time you're putting into it? So for me, I've always been the key principle, like the only 1 or 2 key principles in the deal. So my goal is, we're kind of a one-stop shop. We can do everything ourselves. We don't have to really bring in outside partners, although we're open to it. But, the more we do, the more of that, sweat equity and the more of the pie we can keep.
I was only asking that because where I live, Grant Cardone actually bought a property like a mile away, and I was eyeing it. It looked a little distressed, but it's been on the market for 3 years, and he bought over what the asking was. And I was like, how do you make money on that? And that's why I was asking you. I mean, you obviously make more profits.
They're not always. Yeah, they're not always making money. I mean, dude, there are people buying stupid deals, and Grant's one of them. And I think in many cases, I think I've seen him buy deals here in Austin, for extremely high prices that I would never pay. And I go run the numbers, and it's like, how is he making money for his investors? The only reason that he is being a little bit safe, well, I mean, he's making fees. The investors aren't making fees. But, the only reason that I think he's safe is because he's doing lower leverage, or so I hear. But lower leverage also reduces your returns, right? So, I'd rather have high leverage on a safe deal and make good returns than low leverage on an overpaying deal that might be safe, but your returns suck. So, he might be one of many, and there are many people that are overpaying and doing bad deals. And so I think for anyone thinking about investing in one of these projects with a sponsor, is making sure that they're conservative, that they have a really good track record, and that, they know what they're doing and pay attention and are very hands-on.
Okay. So it seems like how many deals in 2019 did you do multifamily wise? Just raw, like complexes?
Yeah, I did 4.
4, okay. And so what do you think is the biggest bottleneck for you from not buying 100 in your business right now?
Yeah, so a really, really good year would probably be buying. Yeah, 4 is a lot. I mean, that was $40 million in property, $45 million in property. So it's a big, it's a lot of property.
No, I'm not saying it's not a lot, but what's stopping you from doing the crazy amount?
Totally. No, exactly. It's a great question. So I would say like a really good year would probably be buying 8 to 10 properties. And what's really stopping that is the market. And it's just a very difficult market to find good deals. And we're really conservative. We're not willing to bet on the hype of the market that everything's going to go perfectly and overpay for stuff. So most of the time we're getting overbid on for on-market properties by 10 to 15%. And it just happens a lot when, there's maybe 1031 investors or big private equity firms that can accept a little lower returns. They're going in and just paying more than they should. So part of the reason is we're pretty conservative and we can be, we're patient. We have a self-sustaining company, so we don't have to do a deal to do a deal, and we don't do deals to get fees, which a lot of people do. They do a deal just to go get the fees because they can. I can go put together any bad deal right now, make it look great on a spreadsheet, and make $500,000 in fees by buying it, and that would not be difficult. But when you're putting these deals together and you're raising capital and you have investors involved, we have a responsibility to perform. And I think our integrity is just really important to us. And putting together good deals. So I think this year we'll probably do between 3 and 5 really good deals. I don't see us doing 10. The other reason is most of these deals from start to finish, it takes about 3 months and it's an intensive process. So, it takes 60 to 90 days to close on it. Probably a month before that, you're negotiating a contract and going. So, it could be a 3 to 4 month process for every deal that you buy. It's a lot quicker when you're buying single family,
Yeah. And are these deals, so is there a big difference between buying, some like apartment complexes and big, other complexes that aren't specifically like metro apartments? So
could you elaborate a little bit more?
Yeah. So for example, where I am, it's not really metro, it's like suburban. So there's little they're not apartments, but they're basically townhomes, and there's like
what part of Florida are you in?
So it's north of Palm Beach. So it's between Palm Beach and Orlando. So it's there's like a bunch of like 30 units everywhere, and they're getting bought up like crazy. Gotcha. They're on the market, and you go to Miami, you got these crazy sky rises. And so, yeah. And what are the difference between those type of units that you're finding the most profitable? I'm not the expert. That's why I'm kind of.
Yeah, no, that's a good question. There's a ton of different type of product. I mean, so you can find downtown high rises. You could, townhomes, smaller 20 to 30 unit townhomes, like you mentioned, mid-rise properties, garden style, which is more suburban, community style apartment properties, low income housing projects. I mean, there's so many different types of apartments. We really stick to garden style suburban complexes. We're normally not near downtown or in the central business district. We're normally out in the suburbs, in B areas, not low income, not very high income, but where we have middle to middle high income housing. People that are paying anywhere from $800 to $1,300 a month in rent. And we find that that's the most stable and the safest type of multifamily to buy. And we believe that no matter what part of the market you're in, there's always renters for that type of product. If you're buying high rise, I mean, Miami got absolutely crushed in 2008-09. Miami is one of the worst hit cities, right? So a lot of those high-rise projects, mid-rises, and the super expensive Class A stuff really got beat down on because what happens when the people paying the most lose their jobs? They go down to the Class B. Class B might go to Class C, and Class C might go to Class D properties. Who goes to Class A? So, there's nobody above them. So we like to stick in that B and C plus kind of property range. Hopefully that gives you kind of the breakdown you're looking for. But why don't we do the 30 unit properties? It's very hard to scale. The reason we do 100 plus units is because we can have on-site management, easier to find management companies, and we don't have to be as hands-on. So, it's a lot easier to scale when you're getting bigger and bigger properties.
And have you ever considered trying to buy like 100 single family units at a time somewhere close to you in Austin?
No, they never would. It's the reason I like multifamily is because it's under one roof, or you
Hmm.
might have six buildings that make up 100 units, but um, it's just less headaches. When you have 100 different tax bills, 100 different insurance bills,
Yeah.
like I would rather just have one tax bill, one insurance bill, one management company, one set of staff, and one location, and it makes everything so much easier.
Okay. And so what are the cap rates that you're seeing for your investors overall? They got the cash flow and then they get the end when you sell it. I mean, what's the overall range?
In terms of their return on investment, it's really across the board. We target a mid to high teen, uh, average annualized return, which is essentially double or triple what they might make in a stock market investment. But we've hit anywhere from 26% internal rate of return
Wow.
to I've gotten some in the mid 30s. We have one that is in the 80s. We had an 82 IRR, which is
Ooh.
we doubled investors' money in under 2 years on that one. So I mean, it's all across the board, but we have a pretty good track record. But I mean, the market's been great. The market's been really fantastic over the past 10 years, and I've only been doing this for four now. But anything, if you bought anything 4 years ago, it has gone up in value to today. So add on top of that we're good operators and we did some great value add projects. We've gotten some really significant returns to our investors.
Definitely. So on these unit complexes, you said, for example, you bought one at 10 million, basically trying to sell it for 13, get it in cash flowing. How do these fare during a recession type problems? Do they go down to the
Yeah, so
40s, 50s like single family?
no, so that's a good question. Um, what I look at is historical occupancy in certain markets. So let's say, we're in Dallas Fort Worth. If you look historically, the type of product that we buy really didn't go below 88, 89% occupancy at the worst times in 2008, 2009. So if we look at our model and I say, okay, let's say we're running it at 85% occupancy, worst case, we drop the rents 10% and 10, 15%, and the occupancy goes down to mid 80s. Are we still cash flowing? And if so, then I feel pretty good. If I'm negative, then that's probably not the best deal to invest in. And so what we do before we buy all our properties and make offers is we stress test in the financial models that we use. So we'll say, what if we drop to 75% occupancy and our rents fall 15%? What's our break even ratio? And we look at all that kind of stuff. So everything we buy has to pass all these tests before we feel comfortable buying it and putting investors' money into it.
Okay, so let's say, God forbid, an issue had you bought it for 10 million and it's cash flowing positively right now, and a little correction happens, and you're still in the positive on the cash flow, but you'd be almost break even if you sold it after 3 years. Would you continue cash flowing until it went up?
Yes. Yeah. So let's say
Okay.
it's even worse than that. Let's say we're cash flowing a little bit, but it's negative equity. Let's say the good thing is our loan is on that is 7 million. So, we're all in at 10, but our loan is 7 million. So let's say it goes to 9 or 9.5 million in value. We're still positive on our loan. We're still cash flowing, and we get long-term loans from Fannie Mae and Freddie Mac. Normally they're 10-year periods. Over the next 10 years, if there's a correction, typically don't last more than 2 to 3 years. The value is bound to go recorrect and go back up. If we lose $1.2 million in value, but we brought the property to 13 million, we're still even above that break-even point. So that's why we go in and we add value, and we don't like to buy anything turnkey, because if we buy it for 10, bringing the value to 13, the value can drop 10, 20%. We're still above our break even. We're still making money. If we bought it a turnkey property for 10, yeah, it might make good cash flow. But if the value drops 10, 20%, now we're losing money. You know what I mean?
Oh, I definitely understand that. I guess an issue I would think of, I don't know if this happened to you during a recession. Let's say I give you $1 million for this deal, and then the market drops and I'm freaking out and I'm like, Dave, I gotta get this money. I gotta get this money. I gotta get this money. And you're like, I gotta keep cash on. But have you ever had situations like that?
I have not, no. Our investors are all very passive. Our average investment's anywhere from 100 to 250,000. We have had people put $1 million plus into our deals, and it really depends on the deal. If we had a deal where we just JV'd and did a partnership with a larger investor that put in several $1 million, and they're like, I need to sell and get it out. And what we do is we'd walk them through, like, okay, here's where the market's at. If it was in, let's say, worst case scenario, the worst of the worst, and they're at a point where they're losing money, we would explain to them, hey, it doesn't make sense right now to sell it. You're cash flowing. Let's wait until a point where the market's better. We have a long-term loan. We've got a good interest rate. Let's continue operating and cash flowing to the point where, we can improve the property. More value goes back up. We sell it and make profit. But I think what's really important is all of our investors are passive, and they're subscribed to our plan for it, essentially. So we tell them it's a 5-year hold. If they want their money back at year 2 or 3, it's not a liquid investment, and we tell them it's not a liquid investment. So there are ways for them to sell their shares, but it's very difficult. They'd have to find someone to replace it. We'd have to approve of the person coming and replacing their equity. So not common. I've actually never had that happen. So I don't, to solve that problem, we wouldn't take an investment from somebody. If, let's say, for example, if it's they're only $50,000, I want somebody who's got, a couple $100,000 in an IRA and they invest 50,000 with us or 100,000 with us, right? So it's not something that they need to get back at any point.
Okay. And what would you say your highest highs and your lowest lows have been in the real estate industry?
Highest highs. I mean, we've sold a lot of properties and done very well in the past 2 years. So I've actually been a net seller recently. We've sold 4 properties in the last year. I would say that's probably the highest highs. The lowest lows were probably when I first got started. And, I mean, you may know too. I mean, you're an entrepreneur, you run a business. It's a emotional roller coaster at times, especially when you're first getting started. And, especially when you're wholesaling is more of a volume business. So you're always got a huge pipeline. You're working on a lot of deals. And multifamily, we might be, we're only doing 4, 5, 6 deals a year maybe. So, you put together a big deal. This actually just happened a couple months ago. We put together a big deal. It's great. It's going to be a $13 million project. We're buying it for a great price. And we worked on it for 2 months, toured it several times, spent thousands of dollars on legal fees, negotiating a contract with the seller. And literally on the day we were going to sign the contract, she pulls out. We already had $5 million in capital lined up, and we had and the seller backed down and chose not to sign the contract and move forward. So, stuff like that's a bummer, but in the end of the day, that's business. That's how it goes, and that can happen. All you can do is learn and try and do better next time.
Yeah. So obviously you're doing very well. Your model's extremely great here. I mean, have you seen any young guys like yourself go full force in the industry and they just basically fail?
Yeah, I mean, I think everyone has to fail a little bit. I mean, I've definitely had failures and I've learned a lot from them. Obviously, nothing bad enough that it's really negatively affected me. I've never lost investors' money. That's never happened. Something that bad has never happened. I have seen other people try and get in, and they think they keep hitting a wall and keep hitting a wall, and they get stuck, and then they end up quitting. I see that a lot. But I mean, it's certainly not easy. I mean, running a business. Honestly, what I tell people, the biggest reason I've been successful, especially being so young, is I outwork everyone. I work 80 to 100 hours a week, every single week, and I've done it for years now. And, I network like crazy. I utilize all the resources I have at hand, and I hustle. And I think if you do that, you can be very successful in this business. if you don't, and if you're half-assing it, yeah, you're probably going to end up quitting because it's way too hard it's way too hard of a thing to half-ass. But if you put your all into it, it can make you extremely wealthy in not that long of a period of time.
And how many people do you say are on your team at a given time, working on deals and everything like that?
Internally, we're only 5 people,
Okay.
including part-time people. We're if I was to include part-time people, I'd say probably 12. And then if we were to include like our on-site staff and attorneys, legal counsel, we're probably in the 25 to 30 range.
Wow, that's cool. So you keep hammering about the importance of having your network. It's easier to raise money from the network. How are you constantly building your network every day?
Probably the biggest one, social media, to be honest.
Really?
I'm very active on Instagram and Facebook, and I've raised millions of dollars from investors through those platforms, which I found to be surprising. But after time, I realized more and more people were finding my social media pages, go to my website, learning about me, registering to be an investor. We'd build a relationship, and then they'd invest into one of our projects. And so I've kind of double or triple down on social media. That's been huge. And then I go to a lot of events, networking events, conferences, whatnot.
Okay. And so a question I would say is, since you're making money on fees, things like that, you're sinking a lot of the money onto that. What do you do with some of the extra money you make from the company? Do you pour it all in to reinvest it?
Yeah, I reinvest probably 80% of what I make. I don't live off a lot. I live a low-key lifestyle, no doubt. I mean, everything I buy, I like to buy for cash, cars, wherever I'm living, that kind of stuff. And so I put a lot of money recently into a software company that I'm starting. It's a multifamily analysis software company called Real Estate Lab. And so I'm well over 6 figures invested into that, and we're probably going to be in close to $500,000 by the end of the year. And so my goal with that software company is to create the gold standard for an analysis tool for investors that want to buy apartment complexes. I created a spreadsheet over the past few years that has just become wildly successful, and I never intended to sell it, but a couple of people were like, I want to buy it from you. So I put it up on my website for $250, and I've sold hundreds and hundreds and hundreds of them. So, it's done so well, and so many people have used that spreadsheet that I've decided to turn it into an online web subscription-based software platform that's going to be releasing later this summer. So that's in development. And I guess to your question, that's something I've been putting a lot of capital into right now.
Okay. And how would someone be able to find that spreadsheet?
So if you want to find the spreadsheet right now before the software launches, you can find it on my website at www.obsidiancapitalco.com. You could search up Obsidian Capital and it should come up. And there's a free one and a paid version. So you can download the free one. If you like it, you can grab the paid version.
Cool. So what would you say gets you pumped every morning when you get out of bed? What gets you really going?
Yeah, dude, I'm just a deal junkie. I love business more than anything. I could work all day, every day, and I pretty much do. So it's a lot of fun for me. I love the hunt, the chase, finding deals, negotiating up, looking at the numbers. I love sending out distribution checks to our investors. I love meeting people like yourself, young people that are inspiring and doing great things. And I think I just think real estate's the most interesting business there is. So I'm just so passionate about it.
Okay. And so you're obviously a very young guy. I mean, what would you say your 1 year, 5 year, and 10-year plan you see yourself?
1 year, I want this software company to launch and get to 500 subscribers. Company wise, I want to buy another at least $50 to $100 million more in multifamily properties this year. 5 years, I think we can be at the $500 million assets under management mark. I don't see why that's not possible. And then we're starting a development branch of the company. We've got about $25 million in new developments that we're working on right now. So we've acquired the land, and we're breaking ground on some now, and early next year we'll be breaking ground on a couple more. So to build that development branch out.
Wow. So on any given deal, once you buy it and then you sell it and it's basically done, but you still have equity into it, how much is that per deal when you're done with it cash flowing you passively every year?
Passively, while we're holding it. So to stay on the same topic of that deal I talked about earlier, from our sweat equity, we make about $40,000 to $50,000 a year passively on that. We make another 40 to 50 on the investment that we made, and then our asset management fees. So all told, we make shy of 6 figures a year just off that one deal, passively done.
Okay.
And when we sell it, between our investment and the sweat equity, we could make north of $1 million just on the one deal when we sell it in the next 3 years. So you do less deals, but you kind of make more per deal when you shoot for bigger size projects.
$50K per deal passively, it's amazing. I mean, compared to some subject to lease option deals where I'm passively making $6-7 grand a year. But I mean, obviously, it's really cool watching the way that you do it, because it's very similar to a lease option, just with extra zeros. I buy it, I got the option, down payment, you get the cash flow and you sell at the end. I think that's really cool, but I think that's really interesting. I don't know if you have an opinion on this. I've seen, and obviously in California, they're starting to put rent controls in. Have you seen if that starts implementing around the country? Could that be a constraint to your business?
Absolutely. Yeah, I don't invest anywhere where there's rent control. I think it's absurd. So California, I will never touch. I think it's absurd, dude. It's absolutely ridiculous. I would not touch California. If rent control came to Austin, I would stop investing in Austin, and I would go invest in other places. So it can definitely hinder the business. It's a huge risk. Part of the reason I'm an entrepreneur is because I like capitalism and the free market, and rent control just doesn't do that. I think instead of rent control, cities should have more incentives for affordable housing, where developers get tax credits and development incentives, tax abatements and whatnot, so that they can actually afford to develop and charge lower rents, and it can still be a profitable project. So, I think that's a better solution than rent control.
It's insane. California's insane. I got some buddies doing investments over there, and they just halted my rent. I can't bring it. It's insane. But that's cool. So
it's insane. People are still paying 3 and 4 caps for properties. So a lot of people in California are still making a ton of money if you bought in the last 4 or 5 years.
Okay. And so my last 2 questions, I always ask the same ones. So the first one, it's kind of unique to you. So let's say you got all your property sold and a 2008 situation hit again. Are you going to go all in buying multifamilies for discounts, or are you just going to sit back and wait and then analyze and attack?
Oh, dude, I'm already ready to go all in. If a crash happens tomorrow, if coronavirus hits and the stock market goes down 50% and real estate drops, I have, we have a lot of liquidity. We have a lot of investors with significant amounts of liquidity, and we're ready to buy. As long as banks are lending, I think that could be the biggest hindrance to it. Is if Fannie Mae, Freddie Mac, these government-sponsored lending institutions stop, that could hurt. But if they're still rolling, we're still rolling. We're not slowing down.
I feel like I'm talking to an 80-year-old man that's been through it all in real estate. That's pretty cool. On that topic, what would you tell your 17-year-old self if you were in a situation where you're in Austin, Texas, and you had no money and you had to start your empire you obviously have now? What would you do, 17 years old, no money, to become the next Dave Toupin?
Yes, at 17, I would go find a couple people that are doing what you want to do and start hanging out with them. Find some people like me or some people that have been in the business longer, 10, 20, 30 years, and find a mentor and show them that you're ready to hustle. and hyper educate yourself. Listen to podcasts, read books. Do that for about 4, 5, 6 months. Your mind's going to be in a totally different place, and then you're going to actually know what direction to go in. So I think that's probably the best start, because 17 is very young. I think if I started at 17, I wouldn't have as much traction, as what I started at 20. But I think the first step is, like anything, you got to learn, and you got to meet people that are doing what you want to do, because that's going to open your mind up and show you that it's possible.
Wow, that's awesome. So on that note, before we sign off, do you have any parting thoughts you'd like to tell the audience before we go?
Is most of your audience young?
Half of them's young. So half of them starting out wholesaling. The other half, we're helping scale from about making $50K a year in wholesaling all the way up to 100. We got some guys in the millions doing it. It's all over the board, but a lot of the guys that are attracted to me personally are young.
Dude, young people, first thing is you got to hustle. And I think you have to really assess, and be self-aware, how bad do you really want to be successful? Because if you really truly want it, and you say you want it, you've got to back it up with your actions, and you've got to go all in. And so when you hear me say the past 4 years, I literally put in, it's actually almost been 5 years now. I've been put in 80 to 100-hour work weeks every single week. That's the only reason I've been able to scale from being literally broke to a millionaire within that time period. And I wouldn't have been able to do it if I didn't put the time in. A lot of people say, "Oh, I'll just work smarter." Well, no shit. You've got to work smart. But if you work smart and you work harder than everyone else, you're going to grow faster. The next thing is, don't ever think that your age can hold you back. My age, even from when the day I started, I never went into a meeting, a conversation, a phone call, or anything thinking that my age was going to hinder my performance. I had somebody the other day ask me, "Oh, when you first started, how'd you get even attorneys to work for you?" Attorneys are for hire. I just walked in, told them what I needed them to do, and they sent me an invoice, and I made sure it was paid. And so don't ever think your age is going to hinder you. It never hindered me, and I think the solution to that is being confident and like I said, educating yourself so you can talk the talk. You might have to do a little bit of fake it till you make it, but and that's okay. It's part of it. So, I think those two things are huge. And then stay humble. Don't get too fancy. I think a lot of people try. You get successful, you get way too fancy. Just stay humble, live below your means, and reinvest as much of your money as you can. And there's no way you're going to be. There's no way you won't be a millionaire within a 5 to 7 year period.
That's awesome. So I really appreciate you coming on today, David. I'm blown away by just the way you're doing things. You're just adding zeros on top of what I'm doing. I'd love to be where we're at one day, and obviously my audience. So I really appreciate you coming on, and I can't wait to have you on next year when you got even more properties.
Awesome, man. Yeah, you will be there. I guarantee it. It's you're a hard worker. It's going to come. So thanks for having me on. I appreciate it.
Thanks.